For generations, people have believed in one simple financial rule: work hard, save money, and eventually you will become wealthy. It sounds responsible and logical. Parents teach it to their children, schools repeat it, and banks quietly encourage it through savings accounts and retirement plans. The idea is simple: if you consistently store money away and avoid unnecessary risk, your financial future should improve over time. But there is a strange contradiction hiding inside this advice. If saving money is the path to wealth, why are most lifelong savers still struggling financially? Why do the richest individuals and institutions in the world rarely rely on savings accounts to build their fortunes? And why does the modern financial system seem to reward people who invest and take risks far more than those who simply protect their money? To understand the answer, we have to explore how the financial system evolved and why the rules that once rewarded savers slowly began favoring investors instead. In the early 20th century, saving money genuinely worked as a reliable path to financial security. Banking was relatively simple. People deposited money in banks, banks paid interest, and over time those savings gradually grew. During the 1950s and 1960s, savings accounts often paid interest rates between 5 and 8%. Inflation was relatively controlled, wages were increasing, and the economy was expanding in a stable way. A person who saved money consistently could see their purchasing power grow year after year. In that environment, saving was not only responsibly, was effective. But behind the scenes, governments and financial institutions were quietly building a new economic structure that would eventually change how money functioned. After World War II, governments around the world faced massive rebuilding costs. Infrastructure had to be rebuilt, industries had to restart, and economies needed rapid growth. But there was one problem. There was not enough existing money saved in the system to finance this expansion. The solution was the expansion of credit. Instead of relying only on existing savings, banks began lending far more money than they physically held in deposits. Through a system often referred to as fractional reserve banking, banks could create new money through loans. When someone borrowed money to buy a house, start a business, or invest in a project, that loan effectively created new money inside the economy. The more lending occurred, the faster economies could grow. At first, this seemed like a brilliant solution. Growth accelerated, businesses expanded, and economies became more dynamic. But this shift quietly changed the incentives inside the system. If economic growth depended on borrowing and investing, then simply storing money in a savings account became less valuable to the system itself. Idle money did not stimulate growth. Money had to circulate, multiply, and move through investments in order to expand the economy. By the 1980s and 1990s, this shift had transformed global finance. Financial markets expanded rapidly, and new investment opportunities appeared everywhere. Stock markets grew faster than national economies. Mutual funds and pension funds controlled enormous pools of capital, and investment culture began replacing saving culture. At the same time, interest rates on traditional savings accounts began falling. Inflation slowly eroded the value of stored cash, while asset prices began rising much faster. Anyone who owned stocks, real estate, or businesses experienced wealth growth far beyond what savers could achieve through bank interest alone. Consider a simple example. If someone keeps $10,000 in a savings account, earning 1% interest while inflation runs at 3%, the value of that money actually shrinks over time. The balance grows slightly, but the purchasing power slowly declines. Investors, however, experience the opposite dynamic. Over long periods, stock markets have historically returned around 7 to 10% annually. While real estate values in many regions have risen even faster, this means investors are not just protecting their wealth, they are expanding it alongside the economy. The gap between savers and investors became especially visible during financial crises. The global financial crash of 2008 revealed just how different the outcomes could be. Millions of people lost jobs, homes, and retirement savings when markets collapsed. But the response from central banks created a surprising twist. To stabilize the economy, central banks lowered interest rates to nearly zero and launched massive stimulus programs known as quantitative easing. Trillions of dollars were injected into the financial system. This money flowed primarily into financial markets, pushing stock prices and asset values higher again. Investors who held assets saw their wealth recover and eventually grow even larger. Savers, however, experienced something very different. Savings accounts began paying almost nothing in interest. In some countries, interest rates even turned negative, meaning savers effectively paid banks to store their money. The system once again reinforced the same pattern. Those participating in investments benefited from economic stimulus, while those holding cash struggled to maintain purchasing power. Over time, this dynamic produced one of the most significant economic shifts of the modern or rapidly expanding wealth inequality. Those who owned assets accumulated extraordinary wealth as markets grew. Meanwhile, people who relied primarily on wages and savings accounts fell further behind. The reason lies in how economic expansion actually works. When governments stimulate the economy or central banks increase liquidity, the first places that new money appears are financial markets. Stock prices rise, corporate valuations increase, and real estate prices climb. These asset markets react quickly to new money entering the system. Wages and savings accounts, however, adjust far more slowly. As a result, those who already own assets benefit first and most dramatically from economic growth. Economists often summarize this reality with a simple observation: the wealthy tend to own assets. While the middle class primarily depends on income grows slowly, but assets can grow exponentially. Many policymakers recognize this imbalance, yet attempts to correct it often fail because the modern economy depends heavily on investment-driven growth. If investment slows down, businesses expand less, innovation slows, and job creation weakens. To avoid stagnation, governments and central banks continue implementing policies that encourage investment activity. Interest rates remain low to stimulate borrowing. Tax policies often favor capital gains. Stimulus programs frequently boost financial markets. All of these policies reinforce the same structure, one that rewards risk-taking and investment participation rather than passive saving. In other words, the system encourages people to put money into motion rather than leave it sitting still. Recent economic events have demonstrated this pattern once again. During the global pandemic between 2020 and 2024, governments and central banks injected trillions of dollars into the economy to prevent economic collapse. Financial markets responded quickly. Stock prices surged to historic highs, technology companies reached enormous valuations, and real estate prices rose sharply in many countries. People who owned these assets saw their wealth increase dramatically during this period. At the same time, inflation surged, reducing the purchasing power of cash savings. Once again, the pattern repeated itself. Investors benefited from economic expansion, while savers struggled to maintain the real value of their money. Looking at the full story, the difference between savers and investors becomes clearer. Saving money provides stability and financial security, protects against emergencies, and reduces financial stress. But long-term wealth growth typically comes from owning assets that expand alongside the economy. Investments participate directly in economic growth, while savings simply store value. In an environment where inflation gradually reduces purchasing power, stored money slowly loses strength unless it is connected to growth-producing assets. This leads to three important lessons. First, saving money remains essential for stability and security, but it is rarely enough to build substantial wealth on its own. Second, the modern financial system is designed in a way that rewards ownership of assets such as businesses, stocks, and real estate, because those assets grow when the economy expands. Third, inflation quietly punishes idle money over time, meaning that wealth preservation alone is not enough to maintain purchasing power in the long run. Understanding this reality does not mean abandoning saving entirely. Instead, it means recognizing the deeper structure of the financial system. Money sitting still slowly fades as prices rise and economies expand. Money invested in productive assets participates in the growth of the system itself. The largest fortunes in history did not emerge from simply protecting money, they emerged from putting money into motion. And once you recognize this pattern, you begin to see the hidden rules shaping modern wealth. Saving protects your future, but investing determines how much of that future you actually own. If you want to continue exploring the hidden mechanics of money, debt, and the financial systems shaping the modern world, Make sure to subscribe to the channel, because the most powerful financial forces influencing our lives are rarely hidden. They are simply never fully explained.